Hi, everyone. Today is October 20th. I have the pleasure to be joined by Ashish Ultarid, who is part of our investment strategy team here at IG Wealth Management. We're really lucky that Ashish is actually located right here in Alberta. And so I get a lot of face time with him, which is really nice to find out about the strategies that are running on the investment side and what's kind of coming up and able to relay that back to you guys. Ashish is joining us today just to help answer some of the questions that I've had from clients and just wanting to get some of the experts' take and bring that information to you. So Ashish, thank you so much for taking some time and joining me today.
Yeah, thank you, Rizwan, for having me. You'll apologize for my voice, but we'll get through today's, Q&A period.
That's great. No, and we understand. So we'll try and keep it a little short today and just get some information out here. So wanted to start off, obviously, something that's been in the news, seemingly every day or multiple times a day is, of course, Trump and this talk of tariffs. Tariffs are on, they're off. They've been increased, they're now off, or they're on a different product. He's seemingly changing his mind constantly as we go forward. So, a couple of things on that is going to be, what do we really see as the ramifications both to the global and the Canadian economy? I know markets in general have seemed to tune out most of what he's saying about tariffs. Obviously we had a lot of market volatility earlier in the year when that first came up. As time's going on, we really don't see the market reacting too much, but love to get your thoughts on what that might mean.
Yeah, so it all began on Liberation Day in early April. And so when Trump came out with his executive orders with tariffs against all these nations, that's when the market saw the uncertainty. And that's what drove markets down very, very quickly, because that's not what was promised. That was not what was implemented in the campaign. So when these tariffs came down on Liberation Day, as you can tell, within days, they were reversed. Delays were put in place, and there were a bunch of holds that were just kind of kicked down the road. As of today, how it stands is that only about 20% of goods traveling between Canada, United States, and Mexico are actually subject to tariffs. And a lot of that is in effect to steel and aluminum, some copper, obviously softwood lumber. Those are all kind of like target areas. Everything else that falls within our USMCA or the United States, Canada, Mexico free trade agreement have been largely exempt. And Trump and his administration are really picking on the certain sectors that they can squeeze in North America, trying to shore production into the United States. Well, obviously, we all know it takes a lot of time to build factories, get them ramped up. And a lot of these companies are making like promises to get things moving so that they're in favor of the administration. Maybe they'll have a shovel-ready project that they can implement. But generally speaking, it sounds like a lot of companies are waiting it out. One of the reasons why we haven't seen the impact on stock markets as much is a lot of these companies front-loaded their inventories if you were selling goods and services. And the companies that have done really, really well so far aren't even in the trade business. Financials, computer companies, technology companies, they're a service oriented. They don't build things. And so it's really the manufacturers got hurt. The other area that seems to be attacked is agriculture. So, of course, we've seen the retaliation of China with soybeans. There's virtually zero imports leaving North America, or I guess you should say United States, leaving the US for overseas markets. And China's basically, created new trade agreements with other nations. These are the unintended consequences of an administration that doesn't know what they're doing and does not have a strategic plan. I will focus a little bit on Canada. Canada is doing very, very well. Year to date, the Canadian markets are actually up 23% as of today. And a lot of that is because of the financials I mentioned earlier and materials. So materials is your mining, you're extracting things out of the ground, the stuff that people actually need globally. And so the Canadian economy is actually more in line with global markets, not necessarily US markets.
Okay. So, fair to say that it's really more of a wait and see approach. The impact's minimal, obviously, as you said, because of the areas of the market that are doing well. As you bring it back to Canada with, let's say, the material sector, of course, we've seen just how well gold has done this year. So is it fair to say that there's likely still some room to run, maybe given that gold rally that we've seen and we might expect to continue?
Yeah, so let's talk a little bit about gold. It's a very, very important asset class. Number one is that the reason why gold prices were starting to increase significantly since last year is because central banks around the world, like South Africa, China, India, even Russia, were hoarding gold and buying gold before it was even brought out of the ground. And so it bid up the prices, and the spot rate of gold has gone up significantly. Now, because when you have an asset class like that, that's increased in value quite significantly, what ends up happening is retail investors, people like you and me, we try to, get in on that action. It's the fear of missing out. And now the retail market is starting to step in as well. Now, generally speaking, up to this point, we were under the impression that gold was actually had a little bit of room to go. It was fairly valued. We're starting to see that gold is actually in the slightly overvalued kind of peak value as of today. However, the value of gold is also associated with money printing. So a lot of people will associate deficit spending from the US, Canada, Europe. As deficits get bigger and bigger and the debt burden becomes higher, gold also goes up in value. So you got two things working for you. Yes, there's more spending happening on the fiscal side, and you've got more demand for gold as well. And that's going to increase the price.
Okay. So fair to say we'll probably see that rally continue for a little bit further.
Yeah, I think we have a little bit ways to go. We're not, again, assuming that it will continue to rise again by double. But if you've done well in your gold portfolio, or if you've got gold in your portfolio, this is a good time to just take a deep breath, look at what your allocation has done for you. We maintain a low position in our managed assets, and obviously we wouldn't want anyone to get overexposed into any risk category.
Okay. And fair to say, whether it's gold or markets in general that have done quite well to that point, maybe looking at, like you said, take a deep breath, maybe taking, some of those profits sort of off the table and really bringing back to what that neutral weight was of the initial strategy as some of these positions became outsized.
100%. We're not just talking about gold. We're also talking about technology stocks. We're talking about individual names. Last year, the banks got beat up because there were a couple of bankruptcies that happened in the United States. TD Bank went through a significant, a restructuring with the cap on their growth in the United States and the amount of branches that they have in the US. So the financial sector itself was actually beaten up. And again, a prudent investor would see that opportunity as okay, what's my exposure? Do I need more? Do I need less? And just like anything, once you've seen a significant bump up in valuation, it's your chance to say, okay, let's rebalance, let's get back to strategy. Because just making those incremental adjustments over time is really what's going to protect you from any potential risks on the horizon.
Okay. No, that's really good point to make and something we should all try and follow. Coming back to home, we talked a bit about Canada. So of course we have a new prime minister in Carney. What are your thoughts on, I guess, what he's maybe done so far and where he's maybe going to be able to help Canada sort of come out of what we're seeing these days? Obviously, with the trade war with the US being our largest trade partner, we need to pivot as a country. I think if anything, this has shown us, proverbial, you can't have all your eggs in one basket. So we need to diversify. I think he's well respected on the global stage. So hopefully that helps us with some partnerships. But where are you guys seeing, Carney and where we might be going forward as a country?
So there's a couple of things. Number one is we are paying attention to the budget that will be coming out in a couple of weeks. This budget is expected to be pretty expensive. And what I mean by that is we'll be spending to stimulate the economy. We are in the belief that Canada is already running a little bit in the recession territory, right? There are areas of our economy that are just not growing. Some of them are being shuttered altogether. So you look at automotive sector getting beat up by the tariff impact and the inability for these companies that build autos to pivot quickly outside or inside of Canada. So right now they're just concentrating their efforts on the US. You've got softwood lumber, forestry companies that are just unsustainable right now with the amount of cost structure that they have and the loss of revenue. These are things that the world needs, and yet because of tariffs and because of the way that our trade partnerships are, it's just right now very, very difficult for those types of companies to operate. Look at oil and gas here in Alberta. So oil is trading below $60. That wasn't the expectation. Even though we've got growth globally, out in Europe, you got growth in the United States, you've got growth in out east, like in China and India, and yet the demand for oil is about the same, but the supply has gotten really, really high. So that's why you've seen oil prices come down a little bit below than what we need, like as a nation. And so that's what we're worried about. We're worried about kind of where we are in the Canadian economy with unemployment is sitting at 7.1%. That's the highest it's been in a few years. And in order to get unemployment lower, you need to have jobs. You need to have job growth here in Canada. And you also have to have some wage incentives. So we should see wage growth. We should see some fiscal stimulus, whether that's tax cuts or if that's direct spending, right? Like, hey, we're going to start building this infrastructure project. We're going to start, adding, again, I don't know what the policies are going to look like, but by stimulating the economy, you get a little bit of that juice back.
Yeah.
So that's what we're looking for. I know here in Alberta, there's a big push for youth employment. It's that 15 to 25-year-old age group that has even the worst unemployment prospects. And so that's an area we need to focus on so that we can give them an opportunity to earn, start to save up, buy homes, buy cars,
Yeah.
and like again, start to feed that engine.
Okay. And I guess if you look at it on a personal basis, kind of pulling some parallels, right? So, investing in infrastructure, but that's more investing in your skills and your education, especially if you're maybe in that youth sector where we have this unemployment. Really just making sure you're finding what you can market and what can market you going forward. And in general, I guess for households as always, but maybe if we're in this preliminary recession phase, as you mentioned, taking a look at your household balance sheet, right? Where can we maybe trim some costs or allocate, and really just making sure that we have a good base at home to start from, to be able to build off.
Yeah, I think you're absolutely right. I think, the big story last year was mortgage interest rates were, getting really out of hand. People were renewing at 7%, 6.5%. Interest rates have come down significantly since then. However, your 5-year fixed mortgage has not come down. So you're absolutely right. When you're looking at your household finances, find out where, if you do have any debt, where your most expensive debt is, reallocate your resources. If you're continuing to save, you have no debt or low debt, just make sure it's the right kind, where your interest rate is at. Is there anything you can do to accelerate that so that you're out of the woods? And if you're also in a sector that is, impacted by tariffs or recession risks, make sure you have a good buffer. So we do have, we have one oil and gas company that's pulling out of Calgary, and there's some talk, in the province that, you know, um, those folks are going to end up getting, replaced or put out of work, and then they're going to be competing for other jobs. Now, luckily, we're in Alberta. We do have a very stable economy right now. We are growing. We've got net immigration coming into the province from other parts of the country. That's great. However, that could also, just like any other boom and bust cycle, that could reverse. And we're already seeing it, like I said, with the federal budget coming, the provincial budget, I can't remember when it's coming, but all of these things are going to impact kind of how sector growth happens here.
Okay, yeah, and you make a good point. Yeah, oil and gas was pulling out. I know AHS laid some people off last week. Of course, we're going to have to wait and see what happens with the teacher strike here in Alberta.
Right.
Even if they get legislated back to work, which it potentially sounds like it will, are some of these people going to leave the profession now? And to your point, we might see some more competition for jobs. So, really good idea to make sure you have a solid plan that can withstand some of these short-term hiccups, and see what that looks like, and kind of stress test your own financial plan, which of course is what we do for clients to make sure that they can withstand anything that comes along. So that's really important to do. Just with the last couple of minutes here, anything else maybe think is prudent to talk about, or some other advice you maybe wanted to provide to those that are listening today?
I think at the end of the day, we just want to make sure that investors know where to get the information. So we remind everyone to, listen to our weekly podcast. We've got our weekly newsletter. If you're, just thinking of getting a financial plan, just take a look at your existing portfolio and just really understand where the risks are. The last thing you want is to end up with a recession around the corner, or companies, leveraging AI to the point where just like, oh, we don't need to spend as much money anymore building data centers because we've got this new technology or this new advancement. That's really going to shift things. Again, we can't predict how innovative companies are going to be in the short term, but we do know that there's a high concentration of money and focus on artificial intelligence, infrastructure, healthcare, education, and even government services. So when all of these things are in focus, just make sure that your portfolio can reflect some of those risks that are out there, and also enjoy the ride. Markets are beating expectations. They're definitely doing better than what we expected at the beginning of this year. And if that means that your financial plan is on track, or maybe you're even ahead, reprioritize what your needs are, so that if you wanted to, pay down that car or pay down that house or do anything specific to your financial goals, this is the time to do it, because you're in a position where you're actually beating what your goals are.
No, it's really good advice. So thank you for that. And I know everybody listening really appreciates the time, and you taking some time out to speak to us today. So until the next one, thank you so much, Ashish, and you have yourself a great afternoon.